I put 12 popular wealth building strategies through the exact same 20-year financial model. The ultimate ranking completely shattered my preconceptions about how wealth is actually built. If you spend more than 5 minutes on YouTube or financial Twitter, you will be bombarded with absolute certainties. The real estate gurus insist that cash-flowing multifamily properties are the only way to escape the rat race. The crypto enthusiasts claim fiat currency is dead. The index fund purists will tell you that any attempt to beat the market is a fool's errand. Meanwhile, a 22-year-old in a rented Lamborghini is trying to sell you a course on starting an AI agency, claiming a scalable side hustle is the true path to wealth. From a personal finance perspective, this creates an unnavigable sea of noise. To find out what actually works, I built a comprehensive, data-driven model. To ensure a level playing field, every single strategy was subjected to the exact same baseline inputs. I assumed an initial capital investment of $10,000, an ongoing contribution of $1,000 per month, and a strict time horizon of 20 years. That means, over 2 decades, the total principal invested is exactly $250,000. But this meta-analysis does not just look at absolute dollar returns. It incorporates the harsh realities of tax drag, inflation, risk-adjusted returns, and the most critical, often ignored metric of all, return on time invested, or ROTI. We need to know if a strategy requires 40 hours a week or 40 seconds a year. Before we dive into the data, if you appreciate this kind of deep dive financial analysis, hitting the subscribe button is statistically the best return on your time invested today. It helps the channel and keeps you anchored to reality. Now, let us look at the actual math. The biggest trap in the modern wealth industry is survivorship bias. We only see the people who made it. We see the day trader who hit a massive short, but we do not see the 95% who blew up their accounts. We see the real estate mogul, but we miss the exhausted landlord dealing with an eviction at 2 in the morning. When I ran these 12 strategies through the model, I realized that we naturally overvalue the potential for astronomical gains and completely undervalue the friction required to get there. Friction comes in the form of capital gains taxes, unexpected maintenance, platform fees, and psychological burnout. You might find a strategy that generates a 15% annualized return on paper. But if you are paying ordinary income tax on every single dividend and losing your weekends to manage the asset, your real-world net worth will drastically underperform. To make sense of the results, I grouped the 12 strategies into 4 distinct tiers based on their performance in the 20-year simulation. We are going to walk through the absolute wealth destroyers, the high-risk satellite assets, the sweat equity builders, and finally, the holy trinity of wealth creation. The top tier consists of 3 strategies that, when combined, produce the highest mathematical probability of becoming wealthy with the absolute lowest friction. My goal here is not to sell you on a specific lifestyle, but to show you what actually happens to your money and your time when you commit to a path for 2 decades. Let us start at the very bottom of the barrel, with the strategies that look incredibly appealing on the surface, but actively destroy your purchasing power over time. If you think keeping your money in a high-yield savings account is the ultimate safe play, wait until you see how much purchasing power you actually lose. Welcome to Tier 4, the Wealth Destroyers. This tier includes day trading individual stocks, angel investing in startups, and parking your cash in yield-bearing accounts like certificates of deposit or T-bills. The common belief here is either an illusion of total safety or the allure of quick, outsized returns. The internet loves to promote stock picking. The narrative is that if you just research the right companies, you can consistently beat the broader market. Alternatively, the hyper-conservative crowd insists that taking zero financial risk is the only way to protect your nest egg. But when we stretch these assumptions across 20 years, the mathematical reality is brutal. Let us look at the numbers. Let us start with the high-yield savings account. Over a 20-year cycle, assuming a historical average interest rate of 3.5%, your total year 20 net worth hits about $362,000. But when we adjust for a historical 3% inflation rate, your real purchasing power drops to roughly $248,000. You invested $250,000 and you actually lost money in real terms. Now look at individual stock picking. The median 20-year return here is disastrous. According to the SPIVA scorecard, over a 15 to 20-year period, more than 90% of professional active fund managers fail to beat their benchmark index. A famous study analyzed 66,000 retail accounts and found the most active traders lagged the market by a massive 6.5% annually. Your expected value here is terrible. The reason we fall for these wealth destroyers is deeply rooted in human psychology. With stock picking and angel investing, we are driven by the lottery ticket mentality. You hear about the guy who bought Tesla early, and your brain ignores the base rate probability of failure. With angel investing specifically, retail investors suffer from adverse selection. By the time a startup is crowdfunding on a public platform, the smart institutional money has already passed on it. On the opposite end of the spectrum, the person hiding in a high-yield savings account is paralyzed by loss aversion. Watching your stock portfolio drop 20% in a month feels physically painful, so you seek the psychological safety of an insured account. But trying to take zero financial risk guarantees the slow, invisible loss of purchasing power to taxes and inflation. The protocol for handling Tier 4 is simple. Stop treating these as primary wealth-building engines. Safe assets like treasury bills and savings accounts are strictly for wealth preservation. They are where you park your emergency fund, or the down payment for a house you plan to buy in the next 2 years. They are not where you grow your net worth. As for individual stock picking and startup investing, treat them as entertainment. If you want to allocate 1 or 2% of your portfolio to scratch that speculative itch, fine. But recognize that you are paying high short-term capital gains taxes to mathematically underperform a free index fund. If you rely on these strategies to fund your retirement, you are statistically doomed to fail. Now that we have cleared out the destroyers, let us move up to Tier 3. If you are currently chasing high dividend yields to build a passive income stream, you might be accidentally triggering a hidden tax trap that could cost you over $50,000. Welcome to Tier 3, the satellites. This group includes dividend growth investing, real estate investment trusts, and cryptocurrency like Bitcoin. On paper, these are phenomenal assets. The common belief is that dividends and REITs provide safe, tangible cash flow, while Bitcoin acts as digital gold and an inflation hedge. A massive portion of financial media is dedicated to building dividend snowball portfolios or dollar cost averaging into crypto. They feel sophisticated. They give you a dopamine hit every time a dividend notification pops up on your phone. But when we run them through the 20-year model, a massive structural flaw reveals itself. Historically, dividend growth stocks return roughly 8 to 9% annually. If we run our model at an 8.5% compound annual growth rate with all dividends reinvested, our 20-year net worth hits about $638,000. REITs perform slightly better, finishing around $750,000. Bitcoin is a wild card. If we model a highly volatile 15% growth rate, it rockets to $1.3 million. But here is the friction. Unless held in a tax-advantaged account, dividends create a massive cash drag. You are taxed in the year they are received. REIT dividends are even worse because they are usually non-qualified and taxed at your ordinary income rate. If you earn a yield and immediately lose a quarter of it to the IRS, your compounding curve flattens out dramatically compared to pure capital appreciation. The psychological appeal of Tier 3 is all about tangible feedback. Seeing cash hit your brokerage account from a dividend feels like real progress. It feels safer than watching a stock price fluctuate. With cryptocurrency, the psychology is entirely different. It requires an iron stomach. The model shows great 20-year returns for Bitcoin, but the journey involves multiple 70 to 80% drawdowns. 95% of investors simply cannot stomach that volatility. They buy when the price is hitting all-time highs because of fear of missing out, and they panic sell at the absolute bottom during a crypto winter. The reality is that both extreme volatility and inefficient tax structures wear down your psychological endurance over 2 decades. You end up working incredibly hard, managing allocations and tracking yields, only to underperform a totally passive strategy. The protocol for Tier 3 is to use them exactly as the name implies, as satellites. They should orbit your core portfolio, not replace it. Dividend stocks and REITs are fantastic for retirees who actually need to spend the cash flow, but they are highly inefficient during the accumulation phase. If you must hold them, keep them in a Roth IRA to eliminate the tax drag. Bitcoin merits a small 1 to 5% allocation for its non-correlated upside, but anything more becomes a psychological nightmare. To keep all these moving parts organised without losing your mind, you need a proper tracking system. Mid-video plug here. If you want the exact mathematical models I use, check out the official Tom Talks Money Ultimate Personal Finance Dashboard, linked in the description. It is a comprehensive digital template designed to track your asset allocation, project your net worth, and automatically calculate your tax drag. It forces you to look at your money objectively. Now, let us step into the big leagues. Now we enter the territory where true generational wealth is built. But the catch here is not your money, it is your weekend. Welcome to Tier 2, the sweat equity builders. This includes direct single-family rental real estate, buying a boring small business like a laundromat, and building digital products in the creator economy. The myth sold to us here is the dream of passive income. Gurus will tell you to buy a rental property, hire a property manager, and watch the cash flow into your account from a beach. They pitch digital products as an infinite money glitch with zero overhead. It all sounds incredibly romantic. But when we look at the 20-year data, the passive income myth dies instantly. You are not buying an asset, you are buying a second job. The numbers in Tier 2 are staggering. Let us look at direct real estate. Because you use a mortgage, you are leveraging the bank's money. You put $10,000 down on a $250,000 house. Assuming 4 to 5% annual appreciation and using our ongoing contributions for future down payments, your year 20 net worth easily eclipses $1.2 to $1.5 million. Buying an existing cash-flowing small business can push that number past $3 million through massive free cash flow. Digital products have 99% profit margins. If you build software or an educational course, the cost to duplicate it is zero. The potential year 20 net worth ranges from $50,000 to well over $5 million. But these returns are strictly a premium paid for taking on enormous operational risk. This is where the return on time invested metric completely flips. You are no longer investing financial capital, you are investing human capital. Real estate is a part-time job. You are dealing with tenants, fixing toilets, and stressing over a broken roof. When you buy a small business, you inherit key man risk. If the retiring owner held all the client relationships, the business might collapse the day they hand you the keys. The psychological burden of personal debt liability is immense. With digital products, you are competing against algorithms and billions of hours of free content. The burnout rate is exceptionally high. You have to be comfortable working hundreds of hours for absolutely zero financial return until you finally hit an exponential inflection point. It is highly lucrative, but it is the furthest thing from passive. The correct way to handle Tier 2 is to embrace the friction. Acknowledge that these are active secondary jobs, not passive investments. The goal here is to trade your time and effort for massively accelerated cash flow. You use the incredible tax write-offs of business ownership and the depreciation benefits of real estate to shield your income from the IRS. But the ultimate play is not to run these businesses forever. The protocol is to build the equity, generate the high cash flow, and eventually transition that money into truly passive assets. You build the digital agency, sell it for a lump sum, and invest the proceeds. This brings us to the final tier. If I had to start over tomorrow with zero net worth, I would only do these three things. If you want the absolute highest mathematical probability of becoming wealthy over 20 years with the best possible return on your time, you only need three things. Welcome to Tier 1, the holy trinity of wealth building. This consists of broad market index funds, a scalable side hustle, and house hacking. The common belief among most normal investors is that you have to choose a lane. You are either a real estate person, a stock market person, or a business owner. But the 20-year model clearly shows that the ultimate compounding machine is created when you combine the best features of all three and eliminate their weaknesses. You do not need to invent the next big tech startup, and you do not need to gamble on penny stocks. You just need to systematically apply your money and time where the friction is lowest. Let us break it down. Step 1 is house hacking. You use your initial $10,000 as an FHA down payment on a multifamily property, like a duplex. You live in one unit and rent out the other. Housing accounts for roughly 30% of the average American's budget. By having your tenant pay your mortgage, you completely eradicate your largest living expense. Step 2 is the scalable side hustle. Instead of trying to day trade, you invest your $1,000 a month into learning a high-income skill and marketing a service business. The return on investment here can exceed 1,000% annually. Finally, Step 3 is the broad market index fund. You take all the money you saved from not paying rent and all the massive cash flow generated by your side hustle, and you relentlessly pour it into a low-cost S&P 500 index fund. The psychology of the Holy Trinity is brilliant because it perfectly balances effort and peace of mind. House hacking is temporarily uncomfortable. You lose some privacy living next to your tenant. Building the side hustle is stressful and requires late nights. But the index fund portion, the vault where you store all this wealth, requires zero psychological effort. John Bogle famously said, "Do not look for the needle in the haystack, just buy the haystack." Index funds take 0 hours a week to manage. They are incredibly tax efficient, especially when held in a Roth IRA. You never have to read an earnings report or panic during a market crash because you own a slice of the entire global economy. You are funneling active, high-effort cash flow into a completely passive, frictionless vault. The exact protocol is sequence. You stabilize your housing cost first through house hacking to free up capital. You deploy that capital into a scalable service business to increase your earning potential far beyond a standard salary. Then, you automate your wealth accumulation by buying the total stock market. It is boring, it is predictable, and it works every single time. By the way, if you want to surround yourself with people actually executing this strategy, consider clicking the Join button below to become a channel member. We call the group the Optimizers. You get priority replies in the comments and custom sketch badges that stand out. It is a great way to support the deep research that goes into these videos. So, after analyzing 12 strategies and simulating 20 years of financial history, what is the ultimate takeaway for your personal economy? Financial literacy is not about finding a magic bullet. The math of wealth building over a 20-year model reveals a sobering truth. Complexity rarely correlates with higher returns. The financial services industry makes billions of dollars by convincing you that investing is incredibly complicated. They want you to believe you need active management, premium newsletters, and convoluted trading strategies to succeed. The academic and historical data proves the exact opposite. The greatest threat to your 20-year net worth is not a market crash. It is friction. Friction comes in the form of management fees, high-interest consumer debt, emotional trading mistakes, and above all, taxes. The strategies that win are the ones that minimize this friction while maximizing long-term compound growth. Stop looking for the secret strategy that will make you a millionaire overnight. The data is clear. Start a scalable business, buy a multifamily home to live in, and relentlessly buy the haystack. The math takes care of the rest. I want to hear your thoughts on this meta-analysis. Which tier are you currently focusing your time and capital on? Drop your strategy in the comments below for some peer review. I read through as many as I can. Keep optimizing your systems, stay incredibly patient, and I will see you in the next deep dive.